Aloha and welcome. I'm Digital Micro. In this video, we cover smart money, risk management, 5 holistic steps. 5 holistic steps because stronger encompassing the whole of a thing, not just the part. So if I ever ask a fellow trader what's their risk management system and it's only maybe a 2% stop, that's pretty limiting. So I use 5 steps. It helps build a teamwork of energy from 5 elements that we're going to cover right now. Smart money risk management, step 1, deleverage because less is more. I'll give you an example. I trade micro futures, index micro futures to be exact, S&P 500. So the idea of deleveraging is especially important if a higher volatility environment is anticipated. And I'm recording this October 28th on the economic calendar, earnings calendar, and then, of course, we're right before the U.S. election, and then the VIX level is then heightening the economic calendar as later in the week, core PCE, which the FOMC greatly puts a lot of weight into, and the non-farm payrolls at the end of the week. Earnings calendar, we have almost a third of the S&P 500 companies reporting this week. So you can see a lot of things that are going to impact price. So I don't need to have a lot of leverage on an already leveraged micro futures instrument. Smart money risk management, step 2, timing. This is the most important thing I've done, is executing on timing the last 1.5, 2 years of my trading and being precise about when I put a trade on, taking on risk. What is the time of day edge? What is the day of week edge? And where are we with the release of these things on the right side? Economic calendar, earnings, the VIX level, the election impact, and what the timing is before, during, after. But timing overall is just as important, if not more, for me, and where price level actions are on a premium or discount array. That concludes step 2. Smart money risk management, step 3, trade location. This is a key risk mitigation tool that takes care of a lot of issues you're putting on risk. What's the trade location? Is it mediocre or is it a AAA plus trade location? So I'd use a trim and trade technique to optimize for trade location because it's not usually a bullseye, your first trade. So that's why it's so important not to be using a lot of leverage when you're trading. I like to sometimes ease into a trade, and if it's just not going to pop right away for me up or down to a target, I may need to deleverage back to step 1 and add back in to optimize my trade locations. So step 3, definitely a key element in overall smart money risk management. Smart money risk management, step 4, stop. 3 kinds that I like to use instead of a percentage stop. Number 1, an actual price step. Number 2, time stop. How long have I been in the trade since I put it on? Have I been in all morning and afternoon, all day? That's a key thing. And then a dollar stop. If I'm going to trim and trade, the first thing I got to know is how much is this thing running against me in dollars? I want to know very quickly and concisely. I'm going to look on that and then react on immediately if it's going too much against me. The 5th and final, and not the least, smart money risk management, step 5, price structure context. Where are we with buy-side liquidity? What's that premium or discount array? Buy-side liquidity, know it. Sell-side liquidity, same thing. And then, of course, always noting on my charts, premium and discount arrays. These are price inefficiencies. So when I'm taking a trade and taking a trade off, I need to have the context. Context is everything with the price structure, smart money, risk management, 5 holistic steps, the cornerstone of how I trade.